Thanks, man. Appreciate the roll, that introduction, rolling, all that good stuff.
Oh, I tell you what, my pleasure, man. I love putting together a playlist for you, Don. I'd like to launch you into the midday roundtable. A lot of exciting stuff to talk about today.
Absolutely. And that's what we got. A lot of great stuff. Everybody, thanks for joining us. So guests today are Jack Carter, Roger Scott, Celeste Lindman. We are going to cover the earnings season, what that signals for recession, how it's tracking so far. We've got an FOMC meeting again next week. Big rate decision, although 25 basis points looks like a lot, but we need to talk about the implications of that and further down the line. Also, we got the debt ceiling coming real, that's starting to get closer to the top of people's mind. That is becoming very acute. So we're going to talk about that as well. And, we got, and Jack's going to talk to us a little bit about this new VIX one-day contract, right? Markets and exchanges evolve to changing conditions. And this is the latest evolution in that. So that and lots of other stuff. Celeste got some really great stuff to talk about as well. So, this first real quick this morning, the markets about flat, but it sold off pretty significantly yesterday. First Republic, still a problem. I wonder how those big banks feel about their, I think, was it $30 billion in rescue deposits? We looked at this a couple days ago on I do these sizzle stock sessions for some subscribers to my Telegram channel. One of the stocks we looked at was First Republic Bank. It was around $11 or so. Said it still looked like the short, and now it's down to 580, another 50%. So, the banking issue is not done by a long shot. But anyway, with that, let me roll in my guests here. Roger, Celeste, Jack, how you guys doing? Let's give them a second to tune on in.
Hey there. How are you doing, Don? Hey, Roger.
Hello there. How are you guys?
Hey, Jack.
Awesome. How are you, Jack?
Hello, Roger. Hello, Celeste. Hello, Don.
Hey, Jack.
Good to see you guys.
Good to see you.
Yeah. Okay. Well, all right. So we've got, we got something like 158 S&P companies reporting this week. It's probably one of the bigger weeks of the earnings calendar. I can't really tell one way or the other whether it's exceedingly positive. Well, it's not exceedingly positive or exceedingly negative. It's right down the middle, but there's a pretty fair balance around that. Roger, I really want to get your thoughts to kick us off here on that. And I know you take a look at seasonality, what that has to say, what seasonality has to do with earnings and where we are in the cycle.
Well, let me actually, you know what? I just thought of it. I can actually show you.
Let's do it.
Sometimes a picture's worth 1,000 words, right?
That's right.
Here. Oh, there we go.
I come from Missouri. Show, don't tell. Or I lived there for a long time.
All right. Let me just go ahead and let me just share my screen here. There we go. Can you guys see an Excel spreadsheet?
Sure can.
Okay, good. So here's the problem I'm seeing. And this is just to give you guys, good morning, April. Just to give you guys a perspective. This is from Monday till this Friday. So we're already in Wednesday. So just kind of showing you kind of where we stand right now. For the most part, the only seasonality upside that we're getting, and this is based on 20 years of data or 30 years of data. However, since how long these ETFs have been around. But XLF looks to have a pretty strong week, but most other sectors are very choppy this week. And the S&P looks like it's just, it bottoms out yesterday, kind of like it did. Looked like it started the week strong, bottomed out, and it looks like it's now gearing up to move higher. So the rest of the week looks pretty good from here on, but the beginning of this week was very choppy. And again, I'm doing exactly what you guys would do. I'm just interpreting this chart of the S&P. But notice the week starts off on a strong note. And yesterday's a big bang, which we had. And then from there on, it's all upside from here. So I'm hoping that'll happen, but honestly, individually, and when I looked at seasonality on individual trades, I didn't really see.
This is weekly seasonality, Roger? I'm sorry, just
yes, this is for the week we're in. Yeah, this is just for the week that we're currently in right now. Okay. So this is from Monday to Friday. I think it covers maybe the beginning of next week, but this is the only part till I'm looking at till about the 28th. So as you could see here, the S&P as a whole, Doesn't start off. This Monday was kind of okay. Tuesday was a bloodbath. And then today it looks like it's picking up the pieces and taking us higher as the week continues.
Yeah.
But then when you look at the individual, and most individual sectors have the same kind of a thing, like communication does better, energy does a little better, all towards the end of the week. But honestly, it's a very choppy, very uneven, and very characteristic of what we're seeing in the market. Just a very difficult week for the market.
Mhm.
Also, these earnings, they're coming out a lot stronger than I expected, but I'm expecting that to cool off as well. And I'll talk more about that when we get into the main segment. But I wanted to start off with the seasonality and show you that seasonality is very, very mixed. Do you want me to go through some sectors right now, or do you want me to wait till we get deeper in the convo?
We'll pick that up in a second. I want to hear
Okay.
from Celeste and Jack, kind of what you guys
Perfect.
think about the earnings so far, what you're seeing.
You want me to
Celeste, go ahead.
Sure. Yeah.
There we
Well,
go. Sorry about that.
no,
I'm
no, it's
still
all
getting
good,
this
it's all
hosting
good.
down here. Sorry, guys. We're not at my dinner table. We're just, I'm actually on camera. Excellent.
It's all good. Yeah. Well, I think we've been well prepared for what we are seeing in earnings. And
Mhm.
so hopefully a lot of people are not surprised. We've had, been giving a lot of warnings at those key levels. And I think, it's just seeing on paper now what we've been anticipating in our analysis of the different stocks, the different banking sectors, stocks, whatever. So, I think it's, we're into that choppy time frame, talk about seasonality, moving into May. This is the last week of April, moving into that really choppy time frame. I think we're getting a premonition of things to come.
Yeah. How about you, Jack? Notice anything interesting or anything to point out there on the earnings side?
I see a lot of stuff. What I
Yeah.
see, the words don't match the numbers. We
Okay.
got all these talking heads, all these bank guys talking about a recession. And
Yeah.
take a look at Chipotle Mexican Grill today. What's it up? $200 a share? Is it over 2,000, 1,900? I don't know. Well, that's not your cheap drive-through fast food. I think that Chipotle is kind of like a barometer of where people are with their credit card. On top of that, you got McDonald's hit a new high.
Yeah.
Yum Brands, that's restaurants. Wingstop hit a new high. Hershey Chocolate hit a new high. Pepsi hit a new high. These are chocolate. People can do without chocolate in a recession. When you got Hershey making a new high, a lot of the things that the consumer behavior is not matching up with what you're hearing on the financial media.
Yeah, and Microsoft, a couple big tech names are starting to, had pretty solid earnings as well. So there's definitely some strength in the earnings numbers this quarter.
I'm surprised at the consumer. It just really blows me away. And even Visa, they were hitting a new high, and they've got more action than American Express on their card. So it's like the consumer is acting one way, and they're not seeing a recession in earnings. At Procter and Gamble, that's another one. They are not seeing a recession. So the companies that are able to pass on some price increases are going to be the ones that are going to do good. And that's harder to do. Tech. Spotify is going to do that. Amazon did that when they raised Prime. But, McDonald's, Wingstop, stuff like that, they can raise prices and people are still paying it. So their margins are great. And that's very strange to have that happen when everybody's saying the consumer is tapped out and can't even afford eggs. So that's why the numbers I see are not matching with the words that I'm hearing.
Well, and that really, brings to mind, so on the inflation side, right? And the problem where inflation gets really sticky, and then, this could lead into our discussion next, when inflation gets really sticky is, people start trading dollars for anything, right? So getting rid of their dollars for anything, right? They aren't worried about the future. They're worried about spending now. They're not worried about spending tomorrow. They're worried about spending now, right? That's an aspect of that dynamic, and plus, from stimulus past, there's money in people's pockets that they almost can't believe they have.
Yes.
It's things like that that you're right. There's a big disconnect, and both signals look kind of good. It's just hard to tell, so there's got to be some way to marry them, and I just don't know. I don't have the answer for that. One
of the funniest takeaways I got from all this thing was yesterday I was talking to a lady investor, and I mentioned, I don't know this company real well. I love to trade it. It's ELF Cosmetics or something like that.
Mhm.
And I said, you know, I'm shocked that this stock is trending so well, this ELF. It still is, even right now. And she
Yeah.
says, you know, Jack, women would not put food on the table in order to go ahead and get their lipstick.
Oh,
That's
yeah.
I don't know, Celeste, you might be able to comment on that.
It is a consumer staple. Yeah, it is a recessionary proof stock for sure.
Yeah, they'd rather buy cosmetics than put food on the table if it came
Oh,
down
yeah.
to it. So I just think what the consumer is doing is not what we're hearing. I mean, everybody's painting
Yeah.
a negative picture, but people are
Yeah,
spending.
they're out there. It is strong. They've held up. It's remarkable. And I think it takes it certainly takes a while. It takes a while to kind of reconcile what we're seeing, you know? So that's the cross signals, right? So that's awesome. You know, Roger, yeah, why don't you dive into some of those sectors right now? And I think now's a good time to pick that apart, and then we'll head on. We'll talk about the FOMC a little bit.
Let me just give you my before I do, and I will right now. Let me just give you my 5 cents on the earnings front, okay? A lot of the and Jack, I do agree with you. There is a huge disconnect between what we're seeing in the market, but I think one of the reasons now, first of all, there's a huge disconnect. I'll give you that 100%. But a lot of the companies that you've mentioned, not all of them, but a lot of the companies you've mentioned are consumer staples versus consumer discretionary. Not Chipotle, obviously, but maybe these days it is a consumer staples. Maybe people can't live without it, right? But I think what's happening is this. I think people like to put everything in a cute little box in a cubicle. And, you know, this is a recession. This is a bull market. I think we are still seeing kind of like a rebound from the COVID period. And I think a lot of things got mixed up in all of that. And I think a lot of this inconsistency that we're seeing that we didn't see before has to do with it's like someone took our economy and took a bag and just shook it like this. And right now I think we're all still trying to make heads or tails. And because we've never had anything like that before happen to America, COVID was a big deal. Okay. I think it's going to take a few more years for things to be more recognizable in how we look at it versus this whole mix up. Like, for example, just to give you a simple example, I believe the employment numbers are very, very strong or look very strong compared to the rest of the economy because of what happened with COVID. A lot of people we had this workload issue. Then people are getting checks for not working right now. It'll take a little time to catch up. But I agree, this is not a tip. And this is why I say a lot of folks were expecting the market to crash. A lot of folks were expecting the market to go up. But folks, how about the market just doesn't do anything for a while till things straighten out? That's a possibility too. And in that market, you will have a lot of stocks making 52-week highs and stocks making 52-week lows. It's just something different than what we're used to. And I think COVID has a lot to blame for that. Sorry, Don, I didn't mean to get off the topic, but
that's a wonderful topic. All right. I think that, as you're saying that, and as Jack was bringing up his points, and I like the shaking the bad, right? It's created COVID and all the responses and frankly, a lot of other factors just created a massive amount of chaos. And
distortion.
Chaos is like a turbulent stream, right? You've got a lot of eddies that show up rather than a smooth channel, right? And so we're used to a smooth channel of information and things that are easy to reconcile. But now we've just got a bunch of these eddies because, they don't seem to make any sense, but it's just a matter of resolving everything that's happened over the last 3 years and what's going on right now. The question is how long that continues.
Yeah, we can't just say, okay, fine, we're done with COVID. That means everything goes back to normal, hunky-dory, never happened. Life doesn't work that way. It's like when you run for a 5-mile marathon, you're going to get tired the next day. It's just, and after you sleep for 48 hours, you probably want to stretch out. I mean, the point is, this is all based on human behavior. And we have not had anything resembling normal human behavior with COVID in the last 3 years. China's trying to get out of it right now. I mean, it's awful. Anyway, but seasonality. Now, about a month ago, about 3 weeks, less than a month, 3 weeks ago when we were here, I was warning everybody and anybody who would listen to me and saying how consumer discretionary, info technology, and communication services are all the way at the top. Matter of fact, the good thing about this is we have dates, and I'll show you this. And it's very interesting to see what happened since that time. So here we are. Here we're going to go. We were right here. I remember right on this show. As a matter of fact, I remember saying specifically that we haven't been at a level this high since during COVID recovery, since the bounce back. I remember saying that right here on this show. You could see that right here. Right.
So, you might need to share a different, a different view or something like that, Roger. We're still seeing the seasonality chart from before.
Oh, I'm sorry.
Yeah.
Let me, sorry about that. Let me redo that then. See, this is the problems I have.
We got each other's back, man. We got each other's back.
Thank you. Can you see that now?
Yes.
Okay, good. So this was on the 27th of last month. This was exactly a month ago. And I specifically was on here and I said, look, the last time we were up at this level was during COVID, the recovery from COVID. And we're now at 45th percentile. Similarly, I said that information technology was crazy overbought. And I'll show you that one real quick. Here we go. Now look at where it is now. It was right here on 27th of last month. Look at where we're at now. So we're at the lower end now. We're not at the upper end on a lot of these, especially infotech. Interestingly enough, the same thing to communication services. I don't even have to bother showing it to you. Just trust me on my word that it is down there. Also, healthcare is starting to cool off. Healthcare was up there as well. All these sectors that were up all the way up here are now either in the middle or down here. And we're not done yet because there's still a lot of sectors that need to cool off before we go higher. Now, if you look at my CSI scan, which I always look at when I'm doing this, you will notice right here. Let me just show it to you right here. You will notice that on a cumulative basis, these suckers, tech and communications, are still controlling. But look at it on a monthly basis. Look at where they're at. Last spot. Now, it usually flows this way. So it's holding by a thread. And what you're seeing right now is actually kind of what I'm seeing in the market as well. Energies, utilities, consumer staples, consumer discretionary is coming down. It's not going up. And these three should be next to each other. They're still not. They get bent out of shape as the market goes up, and they fall back in line when the market cools off. And the last couple of weeks, these three have been coming back in line. So I'm expecting the defensive sectors to continue leading. I'm not expecting a lot of technology. Microsoft is Microsoft, but I don't think the trend is going to be that positive. I think what's helping us with earnings is the fact that they've been beaten down over the last 2 quarters. And I'll talk about that a little more later. But my point is the sectors are cooling off. Defensive sectors are starting to lead again. The speculative sectors are not in the lead. And also consumer data this week, earlier, I think yesterday, was not that positive either. So things are not looking as good as they are from the representation we're seeing on a lot of these stocks that are making 52-week highs. When you look at it inside, they are not looking as good in terms of the tech stocks. Defensive stocks, consumer staples, yes. Energy stocks, utility stocks, yes. But those are all inflationary stocks. Not seeing that. But actually, Jack, I don't think you mentioned a lot of tech stocks when you were talking. I think most of
No, he didn't. He was mostly
you were
consumers.
That's the whole point of what I'm saying. Is
yeah. I think you mentioned about, if to my best of my recollection, I think about 70% of the stocks that you mentioned were fairly, things people need.
Consumer oriented,
but things people right. Yeah. So I think we're not that far off there either. But that's pretty much what I wanted to show you, and I wanted to actually show you this stuff because it's one thing talking about it, it's one thing actually seeing it come to fruition. And most of those 11 sectors, they still have they still have a place to go. There's still some movement to the downside, and we're only coming out this week with 90 S&P stocks. We reported 90. No, excuse me. Sorry about that. We've already reported as of yesterday about 100, and we have 178 between Monday and Friday of this week. So by the end of this week, we'll have a really good idea. About half of the S&P will be done and the crazy volatility, markets will become a little more predictable. But this week is not a great week to. This is a good week to kind of be very steady, be conservative, only take trades that have very high probability, or just stay out. Because if you're not going to be impacted by a stock that actually has earnings, you may be impacted by its brother or sister that has, like if Pepsi doesn't have earnings and Coke doesn't, if Pepsi has crappy earnings, hypothetically, it's going to affect Coca-Cola. So you're going to get impacted by as a ripple effect, so to speak, I think.
Right. Excellent. And Celeste, what do you with that? So we've got earnings, kind of not a whole lot of direction. And the next thing I wanted to talk about, of course, we got the FOMC coming up next week, and we have to pay attention to it, right? I mean, it's dominating the market, and Jack, and I'd love to get your thoughts on this too. Plus, we got the debts. The House Republicans are starting to present bills to budgets, right, to kind of get through this debt ceiling. Right now, I think the bid is $4.5 trillion. Right, and only set to go higher. Those kind of things are what keeps capital out of the market, man. It keeps everybody on the sidelines, and it makes it hard for the market to find direction one way or the other. Any sense of how this gets resolved, or anything that we should be looking for to kind of how to trade this through July, right? For instance, I guess, and I don't have the chart handy, but Goldman had it predicted that the Treasury would run out of all sorts of backup funds. They got 3 or 4 levels of things that they can do in terms of come up with money, and it was the D date was July, right? Well, last Friday the Treasury announced, hey, how much cash they got, and it was 30% lower than it was expected already, right? So now we're talking end of May, June, right? So now the timeline just got that much more urgent. How much does any of this matter?
Oh yeah, good question. Well, I think, your question too about like, how does this all get resolved and how do we play this? I think there were some really key words that we've said so far on the show, disconnect. And that is probably the best word for this entire year, because it's like the Fed is disconnected from the bonds, is disconnected from the stocks, is disconnected from the consumer, there's just this huge disconnect all over. And it's how all of us humans are reacting, as we said, to this COVID whole play. I've called it this rubber band effect, really since COVID, and this recession that I would say that we are in. More of this rolling recession as it rolls from one sector to the other, and different sectors feel it differently. Like you have some sectors that have lost, had a lot of layoffs. You have other sectors that cannot get enough qualified people. I'm living this every day. It's in my area. I'm telling you, it's not a lie. So it's just, how does it get resolved? And the answer is, I don't know how it gets resolved, but I know that there are ways to play it. And I think we've all talked about it, as we go into summer, being smart, being very equipped with long strategies and short strategies, really that to me are like, fewer days. You're not holding them long-term. Not that you can't hold long-term investments, because there are some really good long-term investments. I'm holding a few of those. Jack has mentioned some of those too. So just being very savvy on, kind of what's going on, being ahead of the market, being smart about it, not being afraid, and not letting yourself get inundated with noise, but using a process, trusting it. It's paid you before, it's paid you in all different kinds of market conditions. Keep using it and keep moving forward that way. That's kind of I don't know if that's really answering your questions, but that's how I'm looking at this summer. One thing I want to add before I let you go on to the next person, but I just sent out this morning to my Telegram channel. I thought this was really interesting. You'll love this, Roger. Seasonality on economic indicators that do not meet expectations. Okay. Mm-hmm. Seasonality of economic indicators that do not meet expectations. Bespoke put this out. They've been tracking it since 2010, and so
Celeste, let me to kind of help clarify that statement. So really, you've got the consent when the consensus estimates come out. Sometimes there's a seasonality to how close those estimates track to the actual numbers as they release, and versus when there's a huge disparity between consensus estimates and the actual results. And you're saying there's some seasonality around whether or not they diverge or converge a lot with those final statements. Is that right?
Yeah. And the seasonality is down through the summer months. It's an upside down bell curve. It's uncanny how 2023 is following it to a T. It's beautiful.
So it gets less predictable as you go into summer. Those economic
Yes.
forecasts become less predictable.
Yes.
Is there any
all
way you
the
could share it? Share the screen?
Yeah, let me
If
see
you
if I can do
I'd love
this
to
here
see it. And you were right. I'm loving how it sounds. So
Yeah, let me get technical here and get the right one on here. Here it is. See if you can see that. And it's a 50-day, basically a 50-day moving average on that since
perfect.
2010.
Yes, totally could see it.
Yeah, so yeah, you can see, I mean, we're just following it to a T, but what's really, to me, is really cool, because this is another seasonality that this follows with the equity market. And that's like, look what happens right around July 4th. It starts improving,
Yeah.
and that's such a turnaround time. So I think, like, I totally agree. It's like, these are such unusual times. I mean, I remember asking you, Don, when you were showing us that picture of the interest rates, and the banking problems and all this. I mean, when has the bank ever gone through problems like this ever? That I don't know of anything like this. So these are unusual things that are happening, but the pattern of it is so similar. The human emotion, the human response is similar. That's the kind of predictable pattern that we have. And that's why I say follow. Don't fall into all the noise. Just keep using your plan and following it, and get plans that pay you in up markets and down markets and sideways markets. That's what we're seeing right now.
Well, Jack, that's kind of a good segue. I think I'd love to hear how you're handling this. Now and actually one of the viewers said something about, it's all, there's way too much noise right now. I'm just looking for cheap dividend paying stocks and getting some income, right? And I know that's definitely goes along your wheelhouse, right? I mean, selling covered calls, income, option related income strategies, that sort of thing. What are a few things out there that look really, really good to you right now?
Options. I've been saying this for 2 years. If it wasn't for the options market, I'd be dead. I'd be riding shotgun on a garbage truck right now, because you can't make any money on a directional trade on a stock, right? But what I see is blowing my mind. Let's take CMG, right? Where did it crash 2,000 today? It's up, what, 200 points?
Now let me see.
2,080. Anyway,
2032.
2032. All right. I'm short the 16.
Holy crap. It went from 8 to, okay, hold on. It's up 14%, up $252.
All right.
Wow.
So I'm short. This was before. This was on Tuesday. I shorted the 1620 put. Now it's at 2,000 and it expires on Friday, and I made over 5%. Do you think I'm going to have that stock put to me at 1620 by Friday?
Nice. Yeah, that's awesome.
Yeah, I mean, there's so much cheese out there in the options market. It's unbelievable, but it's really just not visible to the untrained eye. But I see just tremendous opportunity on credit spreads, even covered calls. But that takes.
Yeah, why don't you share a couple with us? I think everybody would love to see that. You got a few.
The credit spread I got on Chipotle is that I sold the 1620 put and bought the 1615 put and made 5% on that one. That's I do that every Tuesday for Friday's expiration, and that's been working like a charm. But again, it's not based on a real directional move on a stock. It's more based on the stock isn't going to drop down to this level or rise up to another level if I'm using a bear call spread. But that strategy's been killing it. And even in uncertainty, you can still find good volatility in some stocks. And I just can't imagine a less risky trade than the one I have on in CMG right now, in the riskiest market I've seen. So there's still a lot of great stuff out there. If you learn how to focus on it and go after it, it's plenty out there.
Yeah. Awesome. Roger, what are your thoughts on the kind of balancing the debt ceiling, FOMC? I don't think there's anything new to say regarding the rate decision and the path of rates. The markets are still kind of where they were last time we were on last week. But how do you balance this debt ceiling debate? And what are the things that are popping in your mind that you pay attention to?
I generally speaking, I try to keep politics as far away from market analysis as I can. I believe this debt ceiling is priced into the market already. I believe here's how I think it's going to happen. They're going to get into a big debate. They're going to do everything at the last hour of the day, and then miraculously it's going to be pushed back another 3 to 6 months.
Yeah.
How it's been. That's what I think is going to happen.
Well, they come. That's the solution every single time, right?
Every
it's not like
time.
they've never held us hostage for more than a week or two, right? I mean,
right. I mean, it's a game. You know what? It's a big game, and I think it's a waste of time. Exactly, And honestly, it's just I try to just stay away from it, because here's the thing: if I start thinking about all that stuff, it's going to drive me crazy, and it's not going to do anything good to my analysis. Like Jack says, it's just another one of those blinking lights. Less blinking lights, but. The other thing you mentioned, don't we have GDP this Thursday?
Yes.
Coming out? Yeah. Now I think that's going to be very important, and I think that's going to be very impactful. And I think that's actually going to be the last major report that unemployment that the Fed is going to get before May 3rd. And I think right now we have about an 85% chance. Correct me if I'm wrong, Don. I know you keep on this.
It's right around 80% on a quarter.
80%.
Yeah.
Okay, it's now about 80%. So here's what I think. I think there's almost, in my opinion, it's a 99% chance they're going to do a quarter of a basis point rate hike. I think that what they may do is slow things down. Now, I think we're going to, I said this last week, I think the Fed, there's a big disagreement between the bond market and the Fed. The bond market is predicting that we're actually going to go lower. The Fed is predicting we're going to go higher a little bit. So there's a little disagreement. And I think ultimately we're going to end up in this exact same place, because ultimately the economy is not strengthening right now as I see it. It's just kind of humming along. We may see something towards the end of summer, as Celeste brought up, but we're not there yet. I think these earnings are going to be very telling. But till we start getting positive earnings revision, nothing good is going to happen with this market. Also, small caps are not leading anything. And the last 20 recessions that we've had, small caps have led us out of it. So we're not seeing that either. I think we're going to be continuing doing this, but I think the Fed is going to back away from raising rates because the economy is not going to get better. They're going to keep telling us we're doing this because everything we're doing is working. And so we don't need to go as aggressive. But the reality is, I think what they're doing is either not working yet or working very, very slowly. I think the data, the fact that consumer confidence is not good is very, very telling. And we are starting to creep up on those jobless claims every week. We were at 200, now we're at 240, then 248.
Yep.
So there's
They've been trending up since September, right? And
that's
right. To your point earlier, that's one of the knock-ons from COVID is all the stimmy checks and unemployment benefits. That took people out of the workforce. That's how we looked like we had a 3.4 unemployment rate, right? Because the participation was as low as it's ever been in the history of the United States, right? Except for maybe in the 50s when everybody have to work for, all the wives were at home working, right? I mean, that's the kind of market that we've seen, and now that gig is up, right? So they're starting to show up in the unemployment rolls, right? And they need a job.
Exactly. Plus, I'm not really happy. I'm not happy with what we saw with the bank with First. What's the name of that?
First Republic.
First Republic Bank. I'm not happy with I'm hoping that's not going to become a common theme over the next couple of months, because that's a big problem. That's a big problem.
Well, I'll sit here and say it. It absolutely will be a big problem, right? I mean, there's only one way for banks to remove those devalued assets, right, from their balance sheets, right? That's either they can swap them out to the Federal Reserve at the basically discount window rates. The Fed can step in and buy them at par, right? Or they get bought out by another bank, but other banks have the same issue, right? The same capital constraints, the same low earnings outlook. So Roger, I think that's a very big deal among a list of a lot of other big deals. But it's just bubbling under the surface. And what they did was they stuck a finger in the dike with SVB, and now the leaks showing up all over the dike, right? And running out of fingers.
You can lay this all at the foot of Jerome Powell.
100%.
Yes. 100%. 100%.
Started it with the stimulus checks, and he screwed it up now. And this is the one thing I like to tell everybody, is let me see if I could find this.
You're so right. You're so right, Jack.
Let's just roll it back and talk about what is the purpose of the Fed. Now, I'm taking this right from their website. They say conducting the nation's monetary policy by influencing money and credit conditions in the economy in pursuit of full employment and stable prices. All right, we got the opposite of that. So the best thing that could happen on May 2nd is Powell comes out and says, I resigned with every one of my 200 PhDs because we're all students of the game and none of us are leaders with any wisdom and none of us know what we're doing. That would be the best outcome for me. Next time he opens his pie hole, he says he's going to resign because he's got us. This guy is not good for the country. He does not know what he's doing. He's a student. He comes from academia. He doesn't cut his own grass. He's never run a business. You know what I mean? These guys that are so disconnected.
He's inconsistent. He's inconsistent all the time.
He's a student. He doesn't know what he's actually doing. He's just looking at things that happened in hindsight and trying to create an outcome in the future. That doesn't work with a guy that's a student that doesn't have wisdom.
That's the point.
So many on their ivory tower.
So many on the Fed are just students.
Exactly. All of them.
That's right. Yeah, no, in the Fed. Right there, we got it right there in the chat. In the Fed.
I want Greenspan back.
Boy, you talking about
the banking thing go away. People are still, the banking crisis isn't done. I think the Fed's failed on every possible level, and we're going to have more banking problems, and they don't know what to do. Yeah. He doesn't know what to do, and it's just kind of just strange. I really would like to see the Fed go away and just let the market work itself out. If rates need to go up, they'll go up. You don't need this guy pulling the puppet strings. But anyway, I didn't mean to get started on that guy.
Oh my gosh, no, you're preaching to
the
choir
great
on that one, Jack. I like it.
He fires me up. He gets Jack riled up. I'll tell you that.
Hey, Jack, why don't you tell us a little bit about with all this disruption and we've had a market that's gone everywhere and nowhere, right? I feel like I really feel like that's what the last year or so has been. It's gone everywhere and nowhere, right? It feels like a wild ride, but you're just on a roller coaster and you end up exactly where you started. And the markets have evolved and the exchanges have evolved, and you've seen this explosion of zero DTE trading, right? With all this uncertainty, capital is not willing to commit. Hedgers are not willing to lock out long-term insurance. Everybody's just looking overnight, trying to cover the next day. It's a lot cheaper insurance. And now we've got these one-day VIX contract. Why don't you talk a little bit about that? I know that was something that you've had some ideas on.
This is crazy. Well, just first I want to back up and say that zero-day options have become wildly popular. And in March, the CBO estimated that 0 days to expiration options made up 40% of the S&P 500 options trading volume for this year. And that's up around 20% from the first quarter of 2022. So the CBOE really loves this 0 days to expiration option business. It's just booming. Institutions pulled like 1.7 trillion out of stocks, and they're committing it to these 0 day to expiration options. And they're mostly on the sell side. Mm-hmm. I read an article from Bloomberg the other day that said individual investors that are playing this game of 0 days to expiration have already lost 358 million. They lose almost 100% of their money every time because they're taking the long side on these 0 day to expiration options, where the institutions with bigger capital, they're taking the sell side. So if you're going to buy a 0 day to expiration option, it needs to make a really huge move. And that's not very likely. That's why all the buyers are losing. But on Monday, the CBOE said they're going to come out with this VIX 1 day, and the ticker symbol on it is VIX1D. And you can look at that, and this follows the boom in this 0 days to options expiration. But the CBOE chief executive, when I looked at this on Monday, it didn't really give me any edge. I think the VIX itself is broken. And this new 1 day VIX is really, I don't know what it's measuring, but this is a thing that really threw me off. I know the CBOE, they're saying they're going to get more and more and more into products for 0 days to expiration. Yeah. The CBOE chief executive, he says that this new 1 day VIX is the continuation of being able to measure and provide to the marketplace a benchmark that shows the market what volatility is at different tenors. Mm-hmm. Now, when did the CBOE become musicians? Because I don't know what he's talking about when he's saying it shows different tenors.
Mind if I jump in there, Jack? And so what they're saying is, so like on 1 day VIX, you've got the actual VIX that's published, right? It's calculated from actual options, right? So they had a futures contract that bets on the next day settlement of the VIX contract, right? So now you got a futures contracts, and then you can sell options contracts off of that. And the tenor is, how long, whether you're talking about 1 day volatility versus 2 day. The typical VIX futures contracts now is like 1 month out, right? And they've got 2 months out. And so this tenor is just a very short front end. It's like a Fed funds rate for the VIX. It's overnight money.
There's no contract on the 1 day VIX yet. I don't know if there's going to be, but if you look at it, it still looks wrong to me. Like, yesterday or Monday when I looked at the VIX, it was like 17. And then that's saying there's no fear. And then, we get a triple digit move in the Dow. So I think the VIX is wrong. It amazes me how many people use it though. I mean, Roger might be able to talk about this too, but it's like every old timer, and I'm an old timer that I know, looks at the VIX except me. I never looked at it. I don't think it tells me anything. And now this 1 day VIX, I think it's either going to be great or it's going to be terrible. But the jury's still out on it yet. But they're really moving on this zero DTE stuff. The Chicago CBOE is really getting heavily into that.
That was basically my first task when I started trading on the move from the floor up to the institutional trading desk. Was we sent out a note every clay, and I had to calculate the implied volatility, and for that day, and we sent that around to people. So we actually, before they published the VIX, we would send around and calculate a VIX. And so it was it's a big key to trading options, obviously.
Was it accurate? Was your VIX accurate?
Yeah, my math was good. My math was very solid on it, I think. Because you can, all you're doing is taking the implied volatilities of all the near to the money puts and calls on the S&P 500. So then you pull it, the implied volatility is, one of the main numbers that you get out of an option price. And then you just kind of average them. So you could calculate the implied volatility and run that versus it. So anyway, that was what I did.
Short view of the market, though. The pros and the institutions, they don't want to hold stocks overnight, and they're going out there every day selling as much zero DTE as they can on the S&P.
Well, that's the real trick, right? I mean, they're basically selling. Everybody wants this overnight, to buy the risk overnight. And they're out there selling insurance, right? They're just like insurance, selling premium all day long and just raking it in.
So I got to figure out a way to get into that, man. If I could, I'm doing it on a weekly basis now, like 3 days I'm in on an income trade, but I would really like to figure out how to crack this zero DTE stuff and do it every day on an income basis, but
Jack, you're the guy to do it. You're the guy to do it.
I'll figure it out. If it's worth figuring out. I haven't got that deep into it because, as you know, I'm killing it with the regular stocks. So about this.
That's awesome. That's awesome. Oh, good guys. So this has been a great discussion so far. And Celeste, you definitely like to take the market agnostic side of it here, and whether it's going up or down. Why don't you tell us a little bit about? And you've been in markets for a while. You've got this tool. You've been using it since 2012. It's kind of been your go-to thing. You got some time? We'd love to hear about it.
Yeah, let me share my screen here again, and let me tell me if you can. Oopsie, there we go. Share this one. You should see my slide. How to make money in any market. How I do that. Everybody see that? Okay.
Yeah,
sure do.
Okay, good. Well, yeah, it's all about what we've been talking about, eliminating noise in the market and focusing on what really matters, whether it's up and down markets, because I lost a lot of money in the markets back in 2009. I mean, the kind that changes lifestyles. So, I really became a student of, became a student of, because my background is in finance and accounting, but I really had to learn a method that was really solid. So when I say this is my go-to since 2012, this is kind of when some things really, really came together. And I finally got an indicator to show me, to pinpoint, to help me scan and find tools. And so that's what I'm going to talk about a little bit today. But really, my tools are, it's like a combination of these fundamentals, timeframes, and technicals. Okay, so and I just want to take a second to talk about these fundamentals and these timeframes, because I'm going to talk a lot about a technical type of approach of pinpointing these exact kind of turns in the market. They're not perfect. Nothing is perfect. We all know that. there's risk in trading. You all need to know that. You need to understand what you're trading for. You ever click that mouse because you can lose your money. We don't want you to do that. That's why we're coming here and I'm trying to show you what has worked for me. But I loved this. I loved this approach in 2012. I've been using it ever since. I pretty much know it like the back of my hand. Now I can even dream about it and wake up and see trades. It's really cool. That's how far I've come from all the fear and emotions in market to really just kind of fine tuning some things. So we talked about fundamentals today. So we got to say that they do matter. It's not like you have to go deep down into stocks and understand everything, but when you have a little bit of understanding of fundamentally what's going on, that really helps you get on the right side of the market. That's why we're talking about, what's going to go on with the banks, or hey, what's going to go on this summer. It's all related to what fundamentals are, what the economic news is, what's going on with the company, whether it goes up or whether it goes down. And the timeframes is something that I think a lot of people, they don't really understand how to use timeframes. I'm not going to get into a wonderful way to use timeframes, but I'm going to show you how important it is to always go back and look and understand kind of what's going on. And then today, I hope you're going to join me at 1:00 because I'm going to share it all. I'm so excited about this indicator to be able to share it with you all. It just transformed things for me, and I hope it's going to transform things for you. So anyway, let's get started. Here is
Hey, Celeste, before you get too far into it, can you hit the share slideshow, or there's up at the top of the toolbar, because it's a little hard to see.
Let's see if
and
I
we
can
get a
get
few
the
people.
right one. Let's see here. That's what I was trying. Let me do this.
Yeah, so on your window app right there, if you just go to the top, there
It
should
went
be
to the
like a
wrong
share
one.
slide.
Let me do, that is the wrong one. Let me see if I don't think you could, wrong screen. Let me, stop sharing because it's on the wrong screen.
Sorry, I didn't
That's okay.
mention it. Just had a few people asking in the chat.
How
there
can
that
I
really
can't
see
find
it,
that
so.
little thing now. There it is. Okay. Let me stop sharing this one. Let me start sharing again, because I don't know, somebody was saying today, it's like, Jack, I think you were saying, it's like, boy, I'm not technical. I got to figure this thing out. Okay. Which screen is that? That's number 2.
Oh my.
There it is. Okay. I have 3 screens here. So, okay. Let me see. Tell me, do you see, is it bigger now for you?
We're not seeing it.
Oh, you're not seeing it. Oh, that's because I didn't share it yet. I didn't. Oh, I have to push that button too. Too many buttons.
Success.
I just need on and off. That's all.
Way to go. Awesome.
Anyway, is that better for you?
Yes, ma'am.
Okay, there.
And Ray
okay.
thinks so too.
Okay, so anyway,
Definitely.
so that's a weekly chart of Eli Lilly. Okay, and that's from November 2018 to 2023. I know some of this may sound a little simplistic, but it is so very important. I'm looking you in the eyeballs. I'm telling you, this is so very important. I'm not showing it to you for fluff. That's for sure. I don't have that kind of time to show fluff. But you can see, I've lost my cursor here. Okay, there it is. The things that kind of stick out on this chart here, there's a lot of volume here in that 2018, 2019 timeframe, kind of a, solid, just moving sideways kind of a stock. But what people don't necessarily understand that there's a lot of fundamentals going on underneath this particular stock. We come into 2020. Well, this is COVID right here where my cursor is kind of bottom to the left, middle there. That's COVID. And that looks like kind of nothing now to us as we're getting this all into perspective, talking about the whole rubber bands of COVID. So you got that. Then you got, the race for the vaccines and, is Lilly going to come out with one? All these different, all the different stocks. But what people didn't understand is that these companies, these medical companies, and I mentioned this a couple of, maybe it was last week with when Garrett Baldwin came on. I loved what he said. It's like, we're going into the roaring 20s. And I thought that was so well said because these companies they don't just sit in their rooms and what can we make? And, can we sell this or can we do that? They are brilliant people, just like the guys I'm sharing this panel with are brilliant people. And they had a lot of things in their backlog. They didn't just now we can make this vaccine. Isn't this great? No. They had to stop what they were working on to go, do this kind of government mandate to try to help people with the vaccines. You can have your own opinions on that, but that's not the point. The point is that they had a backlog. And I think what we see here is there's the result of some significant things going on in that particular company. Because here, well, look, if I can get to the next one, here's a daily chart of Lilly. This is from November 2021 through 2023. This is the bear market. This is the bear market. Doesn't Lilly look like it's in a bear market? And that's the whole point. You have to look at things somewhat individually. I think Jack is kind of the first one said it's like a stock picker's market. There are stocks like he was talking about Chipotle going up. There are stocks that are tanking. You need to short those. You need to go long the ones that are solidly good stocks. This just happens to be one of them. So that's the bear market. Looks very, very bearish to me. Ha ha ha, just kidding. But something that was really interesting, and I wrote about this, I'm going to show you here in just a second. This here in the middle part of the chart is, do you remember this? This happened in January of this year, January. Do you remember that? Anybody? When the, what was it?
Oh, yeah.
Yeah.
Big time.
Yeah. And when I saw that, I'm like, oh, cool. That I was not long, Lilly. I just want to let you know, because of the indicators that I'm going to talk about at 1 o'clock today, because of the indicators that I use, I was not long Lilly, but I was long Lilly up until right at this point. But I was out, but I knew I wanted to get back into Lilly. And when I saw this happen, I'm like, oh, wow, what a gift to me. And I hope it was a gift to a lot of people. I wrote about it. And let me come over here and click this next. Just to kind of point out a little bit on timeframes before I get to that point. This is an hourly chart of Lilly. And I know most of you all here can say, hey, wow, well, that's kind of a beautiful kind of technical approach right there. It's really nice and calm and smooth. And then boom, kind of the breakout, what you want to call it, cup or whatever you want to call it. It was just a nice transition up on Lilly. And that's why it's, always looking at different timeframes, always trying to keep a grasp on that. But this is what I wrote about on February 6th. I said, the New York Stock Exchange, oh, there's a glitch, oh yeah, okay, sure, we believe that, thank you. And, like, sorry, not sorry, but, we messed some things up. Well, to me, that was a trading range, that they gave us a trading range. To me, using my approach, I'm like thinking, okay, this is where Lilly is going. That's the high right there where my cursor is at the top of that very big red candle. That's the high where Lilly's going. And here's the low, because they're just revealing a lot to us. I wrote about it. And in that article, I said, right there, the line right below that chart, I'd say, well, my natural response would be say, hey, sorry, NYSE, I'm not buying your story. And while that may be true, I'm not buying their story, but I am buying the stock, and I'm looking for an opportunity to buy that stock. And buy that stock I did using what I'm going to show you at 1 o'clock this afternoon. And boy, oh boy, I was glad. And I was trying to point that out to everybody, because I believe everybody has the ability to do the same things, using knowledge, using tools, but you got to have the right tools, because it's complicated out there. And not only is it complicated, but it's emotional too. We've got all this noise that's going on. So we try to take out the noise. Remember GE? I remember I came on here, Roundtable, was it right at the end of the year? And Laura, it was before your time, Don, before you were here on the show. And Laura says, okay, bring us a value stock. And I'm like, oh my gosh, you want me to bring you a value stock? And I've got to be on this show with Roger Scott and Garrett Baldwin. You got to be kidding me. Well, my favorite value stock, I had to say it was GE. And I know a lot of people were shorting GE, but that back to the fundamentals, and back to the time frames, and back to the technical indicators, I knew some inside information, not inside as in nobody had the ability to understand it or know it, but I knew a little bit about fundamentals on GE, and I was long this stock. I was long this stock right when it set up. It showed up on my scans, and I'm like, hey, it's time. It's time for GE. And I shared that with you all. That's when it was very bearish looking. I came out, I wrote about it again. I believe it was early January when for Ask the Pros Premium, we were saying, hey, they were asking, what's your biggest prediction? I'm like, my biggest prediction is that GE is going to be an amazing stock for 2023. And healthcare is going to come through with some really significant breakthroughs. And so I was long GE then too. And now look at the daily chart of GE, you got to say it's no longer bearish looking. It's pretty bullish looking. And there's a lot a lot of headlines about it. So that's basically a little bit about the tools that I use. I'm going to talk a lot more about it today at 1 o'clock. And then I'm going to talk even more about it at the market close with anybody who chooses to join me. So thanks for letting me share all those little tidbits. But that's
you bet,
what I have.
Celeste. No, that's wonderful. Okay, so we got so to be clear, 1 o'clock, right? That's when you're doing it.
Yep.
All right, and I don't know if we could drop a couple links to that. Let me see if I can. 1 p.m. Eastern time. There. Sorry about that. And let me see. I don't know if Raleigh's hopping off because I know he's got to manage what you're doing. But let me see just a second here. This is Celeste. This is great, right? I would definitely encourage everybody to jump in that and join. See what she has to say. I'm looking for the. Pardon me. I want.
Oh, there it is. Laura got it.
Gotta get in on this if you if you want. Everybody's on here because they want to get better, and Celeste is going to help you get a lot better. So don't miss that at 1.
That's right. And there you guys go. There's the link. You join. Sign right up. She's going to be there lickety split anyway. Talking to you guys about it. So Celeste, Jack, Roger had to hop because he's got something at 1 as well. But really appreciate you guys being here with me today. This is it's very interesting times. There's ways to kind of sail over these markets without worrying about the noise. But I love talking about the noise, The noise is exciting. And I'm a little surprised. One of my best rugby buddies from my Chicago days, almost 30 years ago, popped up on the channel here. He's listening to the webinar. So I don't know, small world. I don't know how that happens. Anyway, guys, thanks a lot. And everybody else will be here next week. Again, same bat time, same bat channel. And there's going to be lots to talk about. I'm sure the Fed will be announcing that day. So, we're going to have to talk about that. And lots going on in the markets. Celeste, Jack, thank you very much.
Thanks, everyone. Have a great day, everyone.
Celeste, we'll see you. Right. Thank you, Don.
That's good. Thanks, everyone.